And we are live. Hello, everyone. Welcome to another TradeZero Live Session, where we are excited to have Richie Naso, a Wall Street veteran with over 40 years of experience with us to discuss winning mindset in a bear market. Richie will share his expertise in order to help our trading approach. Hi, Richie. How are you doing?
Yeah, doing okay. Every week seems to be a climactic experience on a Friday at 1:30. Let me tell you. So this is no different today, and maybe this is the worst one we've encountered in a number of weeks. But this is serious stuff, folks. Serious stuff.
It is definitely. I think every week we're thinking, okay, this week maybe was the worst, but the next Monday we come across like different things, too many factors that affecting volatility in the market. So we also wondering your ideas, what opinion, what really caused this rally, what's happening in the market. I mean, last weekend we start with Warren Buffett's selling some of his positions. And then the Japan market crash and a yen carry trade. I don't know. Somebody start mentioning about recession. The fear, the VIX was the highest. I don't know last how many years. So, what are your thoughts? What triggered this sell-offs? Let's say, and what should we expect?
Well, I mean, first of all, you're dealing with a lot of uncertainties, macroeconomics, politically, wars, wars starting, Iran is going to react to Israel. There's a lot of stuff going on with market at very high levels. It's good. It should be pointed out that, in end of August to September are usually weak months in general. Don't ask me why. I don't know why, but history is history, and it proves out to be the case. October, of course, I don't have to go into October, but October is usually a bad month for technology. And so what brought this on? Well, is there going to be a recession? I don't know. Is there going to be more inflation? I don't know. Are interest rates bottom? I don't know. Are interest rates going to start going down? I don't know. Is the Fed going to cut rates? Yeah, 90% plus chance in September. That's right. But now that the employment report shows weakness, and the employment report shows weakness last time around, which has been much weaker, by the way, than announced, does that mean there's a recession? Then the recession word comes into play. So there's a lot of stuff going on here, which makes investors a little skittish. And that's why you see these downdrafts. And right now you're seeing a big updraft because this is 2 days of this. They had, again, the S&P contract in minus territory today about an hour or so ago, an hour and a half, minus 10, 12, 14 is up 32 right now. A major move. And along the way here today, they showed a penchant for not really wanting to crush them. And so the longer they don't crush them, and 10 handles in a market that's been moving 50, 60, 70 handles at a time, which is unprecedented. You get people to gain more confidence. They don't want to miss the market. Deep-pocketed investors who bought less than 2 weeks ago the top of the market have got to put some more money to work here. Because if after 1 week, the market's showing you, after 1 day, 2 days of up, all right, so all of a sudden the market is telling you, all right, maybe we have seen the bottom. Maybe the bottom is in. So the deep-pocketed investors who are bought up here, adding to a position or initiating a position, have got to, if the market starts to show resilience, have got to put money to work. Their jobs, their portfolio, they have to answer to somebody. It's all relative. So they have to put money to work. So the longer the market didn't crater again, all right, the more they were nudged into putting more money to work. And that's what you see going on here now.
Okay. So do you have any guts that we will have better week next week, or we just in some consolidation area?
Yeah. I think you're going to get more volatility, and I think you're going to get more sideways action with a bias to the sell side. Only respecting the fact that history shows us that, you know, the end of August, September are usually weaker months. Does it mean that's the end all to be all, and that's what's going to happen? I don't know. But, you know, I don't like to mess with Mother Nature. So if that's what history is showing, I'm going to keep an eye on that. And I'm not going to go all in this. I am not, you know, I have other positions in a, you know, sort of a more conservative investment portfolio. I don't trade for the most part, but in my day trading activity here, you know, I'm very cautious of near-term movements of the market. And listen, I don't think that the bottom may be in, but I don't think we're going off into the sunset for another few weeks. Okay. And we'll see. Yeah, we'll see.
It's better to keep an eye on the politic, and economic news and decide after that for especially long-term investments. So, Richie, given this market conditions, I think traders would like to, you know, strategize their trading in terms of bear market. So today I would like to, you know, cover that topic, and you know, I would like to learn from you what we can consider on this kind of market conditions as a risk management and a trading psychology. So are you using any specific technical indicators or signals do you recommend traders focus during these kind of markets?
Yeah, well, first of all, people have to remember that, you know, the American people and the investment community at all, it's all well and good when you're buying a market and it goes up. That's what America is. That's what the world does. Yeah. They buy and they go up, and they hope it goes up. And they're very comfortable going up. So what we've seen here is months and months of this going up. And everybody's, you know, very spoiled if they just hold positions. You don't have to be a rocket scientist to buy something and watch it go up. But what they are much less sophisticated on is when their backs are to the wall and when the market starts going down. They don't know how to handle it, okay? So first and foremost, as a blanket statement, okay, in a bear market, you're going to see a lot more emotions, and you're going to see a lot more unsophisticated investors making mistakes. They don't know how to handle the downside. It takes a much more sophistication to be a short seller. Anybody can be a buy and hold person, but anybody can't be a short seller with any kind of intellect. They just can't. So that's the thing, again, a blanket statement in general. The market goes down as a result of that. The market goes down a lot more and a lot faster than it goes up. So that's first and foremost. Now, what does that tell you? It tells you if you think the market is down 20 handles or whatever it's down, and you see this is an excellent opportunity, well, it may not be, because of the level that the market was at. Not too long ago, a couple of weeks, all-time highs. You know, so that's one blanket statement. The second thing with bear markets is you look for a concentration of almost every sector of the market, you know, financials, HMOs, technology, and so on and so forth, research, retailers, you know, so you look for that. And there are certain key segments of the market. Like right now, I would suggest you keep a very close eye on the financials. All right, the KRE index, the XLF index. You know, the banks, you know, during interest rates times will tell you the direction. And if the financial names don't hold up, okay, and they held up, and they were a reason why this market has rallied for, bounced back, I should say, you know, so important segments of the sectors of the market, like financials and semiconductors, are areas that you should keep a very close eye on for signs. Because if the financial market doesn't break, okay, they're going to buy the market. It's going to be a signal for deep-pocketed investors to buy the market. So keep a close eye on the financials. Of course, the KRE houses a lot of regional banks versus the XLF, which harbors a lot of big box banks. They act differently, but they're both financial instruments, and they should be kept an eye on. So in bear markets, if you look like they're throwing them out a window and it's all over, but you see the financials ticking up and being firm, don't be so quick to hit that sell button.
Okay. So what should be exactly focusing on the financial markets? What kind of signals we can understand from financial markets in a bear market?
You can watch the indexes that house numerous financial equities. Again, the KRE, which houses a lot of regional banks. The regional banks are very dependent on the interest rates. They're very interest rate sensitive. All right. If the regional banks are going up, it means the interest rates are going up. And if the interest rates are going up, they're going to be able to charge higher rates. They're sitting on that cash in their bank, and so if the interest rates go up, their earnings power goes up. If those banks are going down, you can bet most of the time the interest rates are going down. They're softer. So the rent, the interest you pay on mortgages and car loans and so on and so forth have a lot to do and reflected in the regional banks that are spread out across the United States. So what do I look for? I'm very sensitive to watching certain segments of the market. Right now are the financials. It gives you a little bit of a clue of where we're going to go from here. And the financials, a lot of the regional banks are involved in the IWM as well. And the IWM is sensitive to the regional banks. So you keep an eye on the IWM also. The IWM houses lesser companies, lesser stabilized companies. There's relatively not a lot of growth in these names until they hit on something. So the IWM is a ETF, is a index that I would keep a close eye on as well. There's a lot of people that are bullish on the IWM. 37% of these companies do not make money, but they have research and development, and they could hit something at any time. They can discover some cure for whatever, toe fungus. I don't know what.
Mm-hmm. Got you. Thanks for that. We have Ben in the chat that says, I like holding short and long at the same time. Different stocks, of course. The difference in expectations causes clarity in thinking. Are you agreeing?
Well, Ben, look, I hired in my broker-dealer a person who created pair trading, leading one asset or one equity against another equity, sometimes in the same space. All right, if the numbers get way out of whack, you could buy one and short one, and that's called a pair trade. And pair trades were developed by a firm called Drexel Burnham, where a number of key professionals came out of. Okay, and they created pair trading, and pair trading is a really good idea. So if you're keeping a long and short, if that's what you're referring to, it's a good strategy, providing the numbers line up. And you can hedge one against the other, either in the same space or two indexes, two future contracts. And I do it often. I have, if I see the NASDAQ NQ contract way up and the YM way down, okay, one side of the chart, this side of the chart, I will short the NQ and buy the YM. And let them balance out. And as they move, I will be taking one off, another off. Sometimes I'll be naked long, naked short. I don't know. But the idea is, and it's a good thought, Ben, to have one asset lean against another asset.
And he says that's very interesting strategy coupled with sector trading strategies. Victoria says, in the battlefield that is the stock market, there are quick and there are the dead. What do you think about it?
In a battlefield that is the stock market, there are quick and there are the dead. Well, I'm not quite sure, Victoria, but the bottom line to me is, I've made trades here today and I'm up pretty good. And I'm done. But I made trades here today that lasted 6 seconds and made $450. 13 seconds made I don't remember. But quick turns. That's what I do. LPQ stands for that. Make quick turns in a battlefield. I don't really care where anything's going. I have an opinion where it's going. I'm right much more than I'm wrong. But for my purposes, I don't stick around to be taken out for dead or carried out for dead. I let them have it. They could go up, they could go down, they could do whatever they want. When I bank that money, I take what the market is giving me, especially if it's 6 seconds. And I'll tell you right now, I'm not exaggerating, 6 seconds. It doesn't look, let me tell you something. Unless you're astute, you can't make 20 trades in a day. Okay? You can't. You shouldn't. All right? Unless you reach a level where you can. And there aren't many people that can. Any professional, for the most part, is going to tell you don't overtrade. And it's true, don't overtrade. But it's relative to what you're seeing. It's relative to the action in the market, for sure. But the more you trade, the more chances you have of getting hurt. And the more experienced you are, the better you can handle that. I go against the odds. I don't do it on purpose because I do it because I can do it. Mm-hmm. But I don't recommend overtrading this kind of market. So, Victoria, it's not a matter of how many trades I make in a day. I mean, some traders make 2 or 3 or 4. Some traders make 30. And some traders make 1, and they wait for a pattern to set up. I have too much of a, I don't know what you want to call it, but I feel I can navigate any market. And I don't limit myself to the amount of trades I make. That'd be like saying, a basketball player, top of the name guy making $50 million a year, is hot as a pistol. Does the coach take that player out without them continuing to stay hot? No, of course not. He'd be out of his mind. Mm-hmm. But as soon as the guy starts missing shots, they take him out, and they should take him out. So as soon as I get cold, if I get cold, I don't give him a chance. I don't get emotional and say, oh, wait a minute, I lost 2 times in a row. I lost 3 times in a row. I'm going to get him back. No, thank you. I'm going to take my chips off the table, folks, just like I did today. I'm going to take it off the table. Okay. So the market is telling me, the rhythm is telling me, when the odds are going to start going against you. Now, watch the rhythm of the numbers, man. I'm telling you, watch the rhythm of the numbers. Watch the way the numbers are moving. Sometimes I don't look at charts. If I see the way those numbers are moving, maybe then I'll refer to the charts to see if it's substantiating what I'm thinking. But watch the rhythm of those numbers. The numbers tell the story. Go with your gut, man.
Is there any specific strategy that you follow to, watch this number? I mean, are you measuring the length of the movements, or what's the tips there?
What I'm measuring is the technical areas that we put out every day at 6 a.m. in the morning, 6:30. We send them out. They're borders. Let me just say that there is nothing that's 100% in anything, okay? Nothing. But the technical areas are borders. The algorithms are programmed to go to these borders. They don't go there right away. Right? The border, the support area is here, the resistance area is here. All right? Market's coming up. If the market gets to here, well, the algorithms are going to take over. They're going to go to here. So when they go to here, they're either going to break out or fail. Either break out or fail. So if one was to take a short at a very important, say, technical resistance area, one could take a short at that particular area and protect that money up 3 handles. Why? Why? The answer is simple. Why? Because if it's going to break out of a technical area in an up market that's been roaring, it's going to go through it. If it's not, it's going to fall off and give you a 5, 6, 7, 8 handle trade, period. And what is your risk? 3 handles. Because you know, after a long run up of the market, if it gets to this level and it's the top of the border, you can't go through the border. If you go through the border, you're going up. So what are you risking? You can risk 3 handles and keep that trade real tight from a money management perspective. That is a winning trade. Whether it wins or not, these trades come up and they give you the opportunity to make this play over and over again.
Yeah. In this case, the odds are in your favor, and then the loss is limited with the stock.
Correct. Yeah. It's very important. These technicals are very important to know they exist. Of course, the algorithms know they exist. Oh, they know it because the algorithms, remember, are programmed by human beings. And the human beings, they don't just, as I say all the time, they laugh at me, throw a dart, the LPQ darts, I call them, up against the Barron's trade table. Financials, whatever the hell they're called. They don't get it like that. They program it. And they program it to historic pricing. The technicals we put out are based on historic prices. So we know where these algorithms are going to go. We believe we know where they're going to go or where they want to go.
Richie, do you have any final golden nuggets from today's session?
Yeah, first of all, Victoria, thank you. Leo, you're always here. We appreciate you. Ben, thank you for participating as well. Victoria, I don't view that as an uncomfortable question, by the way. I really don't. Nothing is uncomfortable to me. Trust me. I've been through it. I've been through it all. There's going to be a lot more volatility to come, folks, and it's going to be. So don't get too comfortable with anything and let the market show you what it wants to do. And the market always shows you what it wants to do. You just have to know how to read the tea leaves. There's not one way to know how to read the tea leaves. This changes as we're talking. It changes 1,000 times. The person you want at the hell or your mentor is this person who can stay ahead of the curve and can read the signals. Okay, and that's what you want. You don't want these fly-by-night characters that are running their mouth all the time. Forget it. They're a dime a dozen. They're out there all the time. They're on television. They're on CNBC. They march like wooden soldiers everywhere. It's a way to do this in a very cheap, it's a very cheap way to do this, as far as I'm concerned. And that's it. So there's going to be a lot more volatility here. There's a lot of balls in the air. With inflation, with recession, and the dreaded word, stagflation, the dreaded word. And that is a dreaded word. If there's going to be a recession, that means prices are going down. That means interest paid on loans and stuff are going down. That means the regional banks are going down. Think about the regional banks. That's it. Think about the banks themselves, the financials at this juncture of the market are extremely important. They will tell you what's going to happen here. The market tells you before it happens. It tells you before it happens. There's no doubt. And the market is always ahead. The numbers, you may not see it at the time. Look at the VIX index. All right, the VIX index, the fear index, $12.34 on tape, on a session. I say, folks, this is historic lows. Market is roaring. The market is roaring. I know its market is roaring. Every time the market has roared in history like this, and the VIX is down at this level, somehow, some way, the VIX all of a sudden you turn around is trading at 20. What happened? Exactly that. As a matter of fact, the other day was unprecedented. It traded up to 65 when they pulled that plug. they're rare. This is so rare. It's ridiculous. That's what you're dealing with. Respect it, man, because the volatility is not going away.